Do you know why HMRC is sending 1.4 million tax letters? Because they can compare your tax return against the information they receive from government agencies, online platforms, and bank reports. And when the numbers don't line up for any reason, you receive one of those. I'm going to show you the 5 red flags that can trigger an HMRC letter, what they can actually see about you, and how to respond without making things worse. Let's start with what the first HMRC letter really means. Imagine you're at the airport, you've packed properly, you follow the rules, and you're just trying to get through like everyone else. But then airport security pulls you aside and says, can you step over here for a moment? They don't tell you what the issue is, they don't accuse you of anything, they don't explain what they're checking. That's how HMRC's first letter often feels like. It's not saying you've done something wrong, it's more like something doesn't look typical, we need to take a closer look. Your first job is to work out what type of letter you've actually received, because not every letter means an investigation. Think of HMRC letters in 3 different lanes. The green lane is HMRC saying, here's the tax we think you owe. This is when you typically receive a simple assessment letter or a tax calculation notice. Usually, this is not an investigation. It's a tax bill based on figures they already have. What you need to do is check the numbers, and if something is wrong or you don't agree with their calculations, challenge them within the deadline. The amber lane is the we've noticed something letter. It will usually hint at something specific like property income, savings interest, overseas income, that type of thing. They're basically saying, before we open anything formal, check your return and fix it if needed. The red lane is the serious one. Here, HMRC is actively testing whether your return is correct, and their questions start to escalate. They tell you which tax and which year they're checking, and it tells you what you need to do and what they need. And just like airport security, what matters most is how you respond. If you panic, over-explain, or start offering extra details they didn't ask for, you can create more questions than you answer. That's why next, I'm going to show you the 5 red flags that usually put people into the amber or red lanes. One of the most common reasons people get a letter is because the money going into your bank account doesn't seem to add up to third-party information HMRC already holds. That doesn't mean they're looking at your bank statements day to day, but if something in the wider picture looks inconsistent, they can have a closer look. Maybe you didn't declare some rental income or savings interest that has been building up across different accounts, or even capital gains. Selling crypto or shares can create a taxable income that many people don't realize needs to be reported. But even innocent cash movements can look suspicious without any context. Moving large sums of money between your bank accounts, receiving cash gifts, or even borrowing money from friends and family. From your side, it all makes sense. But when HMRC already expects one set of numbers and your return presents another, they start asking questions. The second red flag is your filing behavior. Late returns or messy filings doesn't automatically mean wrongdoing, but it can make you look unreliable. Filing late once is common, but repeating it year after year becomes a pattern. And from HMRC's point of view, repeated delays often mean that your admin is weak, and weak admin increases the chances of mistake. That's why late filing can lead to follow-up questions. And the same goes for frequent amendments. When you change a return, that's not suspicious on its own, but lots of changes can look like numbers have been adjusted retrospectively, especially if the changes are more frequent. The third red flag is when you claim expenses that look unusually high for your sector or your income level. There is no magic number or percentage that makes you stand out, but HMRC compares your expenses and profit to your previous year's tax return, and they also compare your profit margins to other businesses that look similar. For example, a plumber might have a year where they invest heavily in tools, a van, insurance, and training. Suddenly, their profit margin looks much lower than last year or to what HMRC would expect from businesses in that trade. That doesn't mean investing in your business is wrong, as long as you can explain why this year looks different and back it up with evidence. One extra trigger that people don't realize matters is refund claims. If you have been claiming tax or VAT refunds consistently, or your claims are much bigger than normal, it's more likely to get checked. Not because claiming a refund is wrong, but because HMRC is about to pay money out and they want to understand why. If this applies to you, you need to have the evidence lined up so it's easy for you to prove. The next red flag is becoming more and more common, and a lot of people don't even realize it applies to them. If you earn money through platforms, marketplaces, or apps, there is a very good chance the HMRC already has all the information. Digital platforms such as Vinted, eBay, Airbnb, and Uber were required to start collecting seller data for HMRC from 1st of January 2024. That could be for things like freelance platforms, selling through online marketplaces, paid collaboration or affiliate marketing, booking platforms, so on. From your side, it might feel almost informal, like it's not really a business, it's just a few jobs here and there, or I didn't even make that much profit. But HMRC would have received information from that online platform that there is some activity, and if you don't declare anything, they might start asking questions. If you sell products or services through an online platform, you need to keep a basic records of what you invoiced, what are your business expenses, and what is your taxable income. If you can show things clearly, you won't have to worry about this red flag at all. The last red flag catches people off guard because they don't expect it at all. HMRC have modernized the way in which they look for patterns and discrepancies. Nowadays, they can compare declared income with other data they receive, and sometimes that might include publicly available information. If someone reports modest earnings but appears to fund holidays, renovations, or major purchases, you might get flagged up. Sometimes the explanation is completely normal. You might have borrowed money to go on holiday or buy a new expensive car, but the problem is the HMRC works off partial information. They only see the lifestyle. So when spending looks higher than income and there's no visible explanation, it creates a gap in the story. And after hearing about all those red flags, most people start wondering, so what can HMRC actually see about them? And the honest answer is this. They already hold and receive a lot of third-party information. Reports from employers and pension providers, saving interest reports from your bank, digital platforms, and other government agencies. They have even entered into partnership with the US giant Palantir to help them process large datasets and look for outliers. All this doesn't mean they're automatically looking at your bank account, at least not yet. Just like airport security could search every bag and question every traveler, but they don't, because it would be impossible to run an airport. In a similar way, HMRC don't sit there reading everyone's bank statements. But if your case is flagged and the early questions don't clear things up, they can ask for more information and request supporting documents. They can ask for bank statements, they can access information from the land registry or DVLA, they can ask foreign governments about overseas income. In other words, the depth of the check tends to increase when the first explanation doesn't settle the issue. That's why the first letter matters so much. It's the stage where HMRC decides whether this is a simple clarification or something that needs more attention. So what should you do if you get one of these letters? Well, the very first thing you should do is verify that the letter is genuine, because scam letters and fake HMRC messages are very common. Avoid calling the number on the letter or the email. Go to gov.uk and use the official contact routes. I will also leave a link below for HMRC's own guidance on how to check if a letter you've received is genuine. If the letter is in fact genuine, most people respond in one of two unhelpful ways. They either panic, start explaining things they weren't asked about, volunteer extra information, and try to defend themselves in advance. That's how small issues turn into something big. Or they do what actually works. Answer what they've been asked, stay factual, and avoid guessing. Your goal is to make it easy for HMRC to understand the situation without creating new confusion. In practice, that means get your records organized before you reply, check the letter for the exact response window and don't ignore the deadline. If something is unclear, ask for clarification in writing instead of guessing, and if the situation starts to feel bigger than expected, get help from a qualified professionals like ourselves or others. And if while checking your records you realize you genuinely made a mistake, maybe you left something out or got something wrong, it's always better to be upfront. Explain it clearly, provide what is needed, and pay any extra tax that is due. HMRC is usually more reasonable when mistakes are corrected early compared to problems being found later. And if you want to stay out of trouble long term, you need a simple system you can follow throughout the year. So watch this video next where I walk you through an easy to follow monthly framework that will keep you organized and ready.